Hi there, welcome to kneppyinvests. One of the things I'm doing right now to improve myself as an investor is to try to understand financial statements a little bit more than what I do now. Even though I do have a background in economics, I do have an economics degree, I really just have a basic understanding of financial statements. So I really want to improve that. Now, when it comes to financial statements, my favorite by far is the cash flow statement. And there are a few ways you can actually show the cash flow statement, in particular, cash flow from operations. There's the direct method, which is the preferred way or method for Australian companies on the ASX. And there's the indirect method, which is the preferred method for companies on the American exchanges. And in this video, I'm going to discuss the differences between the two, which method I do prefer, even though there are some flaws to that method. And I'll be comparing the cash flow statement for the first half of financial year 22 from the company called PWR Advanced Cooling Technologies. Also look at that balance sheet, look at their performance for the first half, and the market has reacted positively to this company's performance. I'll compare the cash flow statement to an Amazon cash flow statement from a few years ago and just look at the differences between the two. So I think it's a good idea to understand the differences between the direct method and the indirect method. They both come to the same conclusion, but they just go different ways to get there. So let's get stuck into it. And because this video is focusing on cash flow statements, direct and indirect, looking at PWR, just a few facts in regards to this company. PWR is all about advanced cooling technologies, primarily for automobiles, racing cars, that sort of thing. It's a father and son team, and the name PWR is actually derived from Paul Will Radiators. The father is Keys Will, fairly apt name for this sort of company. I think that's right. Pretty sure Keys Will is the father, Paul Will is the son. Company was founded in 2003. Keys Will, the father, has had extensive experience in this area. And again, their business is Advanced Cooling Technologies, providing cooling technologies for F1, NASCAR, and V8s. They also have advanced, there's sort of, even though they are advanced cooling technologies, they're also diversifying into other areas. And those other areas are what really got me interested in this company, because it looks like there are some really interesting stuff in the pipeline for this company. But this video is not talking about those pipelines. It's talking about their financial performance for the first half of financial year 22. This particular slide comes straight from their presentation, page 6, their performance overview. You'll notice, if you're a little bit astute, that they did leave some things out, which I prefer they don't leave out, including cash flow from operations or even free cash flow. And there is a reason they did leave that out. Now, when you look at all these metrics they did provide in the performance overview, everything is green, everything's going up except two fairly significant things, and that is cash and deposits on hand, and also return on equity went down over the past year. Anyway, they do have a market capitalization here, and the market cap of this company increased 90% over the past year. And when you compare the increase of the value of this company increasing by 90% and then compare that to the financial performance, you can see the value of this company has increased at a significantly higher rate than the profit, which grew 14%, EBITDA 16.6%, revenue 22.3%, earnings per share 13.9%, dividends per share 25%. So the way you get the market cap or the value of a company to increase at a greater rate than the financial metrics is that's all about multiple expansion. And multiple expansion is just showing that the market is willing to pay a little bit more of a premium for that company. The market might be expecting the company to grow at a faster rate in the future, that sort of thing. Now, cash and deposits fell 0.4%. Return on equity, which is something I do look at, that also fell, but still at 26.8%. That's pretty high. And as I mentioned before, there's one thing that didn't show here, and that is anything to do with cash flow statement. And I'm pretty sure if the cash flow statement looked really good, if operating cash flow had grown by 30%, they would have included that in this performance overview. But there is a reason they left it off, and that's the whole point of this video today. Now, before we have a look at PWR's cash flow statement, I just want to compare the direct method and indirect method of the cash flow statement. And this is straight from some website, some educational website online. And the direct method is on top, and this is the preferred method used by Australian companies. Now, with the direct method, this is the simpler method. It's also the more accurate method because it's just looking at cash transactions by the company. So you start off with cash received from customers, then you subtract cash paid to suppliers, and then some other few things as well. And then you come out with net cash from operating activities. Now, I'm going to ignore investing activities and financing activities when we're looking at both methods because they are almost identical. But the main thing here is this is the simpler method, the more accurate method, but there's a couple of flaws here. The main flaw here is it doesn't look at working capital changes. And this is something I am interested in for all companies because if, for instance, if a company significantly increases their inventory, that is not expressed in the operating activities. You don't know that's why or how that has affected cash flow from operating activities. Or accounts receivable, accounts payable. That will have an effect also, if there is significant changes in both of those, on the cash flow from operating activities. So that's the one minor flaw in the direct method. But there are ways that companies can address that, and PWR did that, or addressed that issue in their presentation. I'll show you that, or how they addressed that later in this video. Now let's go to the indirect method, which is the preferred method used by American companies. And you start at a totally different base. So instead of starting at cash received by customers, you start at net income, and then you subtract and add different stuff like depreciation expense. You also add and subtract working capital changes like decreases in accounts receivable, increases in inventory, or increases in accounts payable. So this is a preferred method used by American companies. And on occasion, when I do see this method being used, I won't say I get upset, but I sort of wish companies use the direct method because it's the way I was brought up, learning how to read cash flow statements. Maybe I'd have a different opinion if I did most of my learning in America. Maybe I would prefer the indirect method. Now let's have a look at PWR's cash flow statement for their first half of financial year 22. This is the direct method. Always start off with cash receipts from customers, then you subtract cash paid to suppliers and employees. Seems fairly simplistic, and it is, but it is the more accurate and it's easier to produce as well. Now, with PWR, there were a couple of red flags that I did see, and that's one of the reasons why I did this video today on this company. Now, receipts from customers did increase from 40.4 million to just shy of 46 million, but there was a significant decrease in cash flow from operating activities. In fact, it fell from 14.3 million to 6.6 million. And that's all the information you have just by looking at the cash flow statement. Why was there a significant decrease in cash flow from operating activities from 14 million to 6.6 million when all the other financial metrics of the company were up, were in the green? And this is the reason why the company left cash flow from operating activities and free cash flow off their performance overview in that presentation. So whenever I see this sort of strange thing in the cash flow statement, I want to understand why there was a significant decrease in cash flow from operating activities. So that's what I had to do with PWR. Fortunately, they did give us some clues, but I'll get to that later in the video. And usually when I do see this sort of thing, the next step is going to the balance sheet. But before we go to the balance sheet, I just want to show you the direct or the indirect method using an Amazon financial statement from a few years ago. And this is an Amazon financial statement, cash flow statement from 2017. They had 3 years of history here. And in the indirect method, you start off with the net income. So for 2017, that was 3.0 billion. And then you work your way back from there. Depreciation of property, amortization, you add $11.5 million, so a fairly big expense for Amazon in that particular year. You add back stock-based compensation, then you also subtract inventories, subtract accounts receivable, add back accounts payable. Now, whether you add back or subtract those three is dependent on how much it changed over the past year. So you can see working capital changes when you look at the indirect method. It's the one positive of this method over the direct method. But again, companies who use the direct method can solve that slight flaw in the direct method via some other ways. And that's exactly what PWR did. But I'll show you that in 2 slides' time. The first financial statement I always look at is a cash flow statement. And if I do have significant questions, just by looking at a cash flow statement, I will go to the balance sheet. And if those questions in regards to cash flow statement are in regards to working capital changes, you will find some answers possibly in the balance sheet, because this is where you see changes in inventory, changes in trade receivables, changes in trade payables. For instance, for PWR, their inventories increased from 6.5 million to 9.5 million. So they actually did increase the inventory on stock. Trade receivables fell from 9.3 million to 8.9 million, and trade payables increased from 5.3 million to 6.4 million. No complete answers here to why the cash flows for PWR did fall by a significant amount, but there were a few clues here. For instance, inventories did increase by a significant amount, and that would have had an effect on the cash flow for PWR, but not by $8 million. Fortunately, PWR did give us some explanations in their presentation on page 12. And this page in their presentation, working capital and cash flow, perfectly explained why there was a significant change or decrease in operational cash flow from last year to this year. And it's all about working capital. So working capital increase from last year to this year was 6.4 million. Compare that to last year, it was only 35,000, which was an increase. And that did have a significant effect on the operational cash flow. In fact, if you look at the cash flow from operating activities and you exclude working capital changes, there wasn't a significant decrease, but there still was a decrease. And that decrease was from 17.3 million to 16.0 million. The other things they mentioned here is in the previous year, they received $2 million in COVID support. And in the prior period, there was a $2.7 million customer contract prepayment, and that affected the cash flow from operating activities last year. And if you take that into account, the cash flow from operations actually did increase from last year to this year. So just don't look at a cash flow statement solely. You have to dig a little bit deeper sometimes, particularly if a company is using the direct method. Now, a brief look at PWR's daily chart. This goes back to August 2020. There was a period here where the share price of this company was just going sideways. And when you see a share price going sideways, what you want to do, particularly if you like that company, is just wait for a breakout in the share price. And that breakout in the share price happened in February 2021 when the company released the half-year report. And the buy price at that point in time was about $5.20. And then from there, the share price increased, almost doubled from $5.20 to a high of $10.20 over about a 9-month period. And ever since that high we did see in November of last year, share price has struggled a little bit. In fact, share price has pulled back all the way to a low of $7.20. But there's been a little bit of strength in the company's share price over the past month, ever since that overall weakness in the Australian markets. And the market actually did respond to the half-year report quite positively compared to the overall market. Share price increased 1% when the overall market actually fell 1%. It does look like there is potential that the share price of this company wants to move into at least a short to medium term uptrend. So I'm keeping a close eye on the share price movement over the next few trading days just to see how the market reacts to this report. So sometimes you just got to wait a few days to see the overall reaction in the market. We've now in the weekend gives some analysis a little bit more time to digest the half-year results. And it wouldn't surprise me to see the share price take off a little bit from here or pull back a little bit as well. So we can remain patient with this company because the share price has almost doubled in the past year when the financial metrics haven't. So the market is willing to pay a little bit more premium right now than for PWR, and when the market is willing to pay a little bit more of a premium for a company's shares, I am willing to be a little bit more patient with that company. That's all I have for this indirect versus direct cash flow statement video, looking at PWR and also looking at PWR's remaining financial performance for the first half of financial year 22. If you do have any questions about the direct versus indirect cash flow treatment, and particularly if you are an expert in accounting, expert on cash flow statements and the direct or versus direct method, I'd love to hear your opinion. Maybe I said something completely wrong, but I'm in the process of learning, and one of the best ways to learn is to make mistakes. So if I have made a mistake, please let me know in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out an advisor who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.